Hi there, and you're watching Dukascopy TV. For a very special look at Mark Carney's speech today, I have Michael Hewson on the line, and he is a markets analyst from CMC Markets in London. So Michael, Carney today said guidance doesn't actually prevent the BOE from adding more stimulus. So what are your thoughts on Carney's comments on stimulus and interest rates? And do you think this speech was more dovish than you actually expected?
At the moment, the pound's holding up fairly well. The speech wasn't particularly dovish, but it wasn't particularly hawkish. I think what Mr. Carney did was he took great pains to reinforce what he said at the inflation report a few weeks ago, and also what the Bank of England first said when they published that statement in July. This speech was pretty much as markets expected. Mr. Carney was always very constrained by the mandate that the Bank of England currently has. He's got very little in the way of policy levers with respect to signal any further stimulus measures other than the ones that the Bank of England is already committed to. He's right in that it doesn't provide, or doesn't prevent the Bank of England from adding more stimulus, but at the moment, given the current data trajectory, there's no reason to add further stimulus. We're looking at growth. Growth is continuing to push higher in Q3. Unemployment is starting to edge lower. And all the key business sectors appear to be showing a decent level of business activity. So there would be no reason for Mr. Carney to add further stimulus, given the fact that the economy is recovering, irrespective of what short-term and long-term rates are doing.
And Michael, speaking of business activity, Carney mentioned productivity a number of times today in his speech. Do you think the UK economy really does have the potential to grow as much as Carney believes it can?
Well, obviously the Bank of England's projections for growth in the UK economy, they have to be taken with a certain element of salt, because the Bank of England's projections on inflation haven't been that accurate, so there's no reason to suppose that their projections on growth will be any the more accurate. Having said that, is there any spare capacity in the economy at the moment? Yeah, there probably is. Will we get further growth going forward? The hope is yes. Certainly the business activity that we've seen so far in Q2 and Q3, the upward revision in Q2 last week, does seem to suggest that the UK economy is recovering well. The biggest concern that markets have, I think, is that it's the wrong type of growth. But at the moment, any growth is good growth, and as long as manufacturing and construction continue to grow at the rate they have been in the last two quarters, then I think the prospects for the UK economy at the moment look fairly promising. And
Carney said the 7% jobless rate is a threshold, not a trigger. Do you think the UK can reach its jobless rate goal?
Well, Mr. Carney's estimated that unemployment will probably fall to 7% by 2016. I think we could hit 7% quite some time before that, and so does the market. And certainly if you look at the trajectory of the fall in the unemployment rate since the end of 2011, the rate of travel with respect to the unemployment rate would support an unemployment rate falling to around 7% well before 2016. And that's really why you're seeing the push up or the push higher in yields. The market doesn't really believe that we won't see some form of knockout before 2016. And the reason for that is last month's ILO unemployment numbers. The individual number was 7.4%. The most recent jobless claims, monthly jobless claims figures, would appear to suggest that the August ILO number next month could fall from 7.8% to 7.6%, which would mean that with at least 3 years to go, the unemployment rate is 0.6% away from its threshold.
And finally, what are your views on his comments regarding liquidity for banks?
I think it's a positive thing. Basically, the caveat was that they still had to be in compliance with Basel III. So relaxing liquidity requirements on banks once they've met those capital targets is potentially could free up £90 billion, which is money that can go into the UK economy. So that's obviously very positive for, the supply of credit into the economy, and hopefully will boost growth and various other types of company lending going forward. So I think that's a positive. I think that's a positive for the UK economy.
Thank you very much, Michael, for that. Well, viewers, do stay tuned to Dukascopy TV for more economic updates. But for now, have a good day.